Thank you very much indeed, Kevin. And yes, I am Melanie Leech, Chief Executive of the British Property Federation, the representative body for the whole of the UK real estate industry. And I'd like to add my thanks to everyone in the room and watching us online, to all of you for joining us. This could be the model for the future for the next few weeks at least, I think, for events. So I feel like we're pioneering and setting a new standard for how to do things in the shadow of coronavirus. Today's event is all about revolutionising real estate investment. And as Kevin's already touched on, we've got a stellar panel. And the kind of issues we're going to be asking them to look at is the challenge of improving the infrastructure and the real estate that we need to create better working environments for businesses, new homes for people, to drive productivity, and to level up across the country in the way that the Prime Minister, and echoed by the Chancellor yesterday, made very clear that is the government's ambition. And if we're going to do that, that's going to require public-private partnerships in innovative and unusual ways. That's going to require new investment coming into real estate and into infrastructure. And so today is all about trying to figure out how do we do that? What are the models that work? How do we drive that new investment? How do we create an attractive environment for investment? How do we create the information that's needed? How are we transparent about the decisions that we make? And how do we put all of that together in a way that is a really compelling proposition from UK real estate? And we don't have to start from scratch. We can learn from cities around the world who have faced up to this challenge, faced into it. And I'm hoping we're going to hear from each of our panellists about their expertise and their experience and bring that to the table. And Kevin rightly said, hold your questions to the end, but please don't hold them for so long that you lose them. This is meant to be an interactive session. We really want to hear from you, and you will want to hear from this amazing panel. So I'm just going to introduce them very briefly. First of all, before we come to panel discussion, we're going to hear from Kersten Bell in a minute to set out for us Kersten Muller, I'm gabbling my words. Kersten Muller of Grant Thornton, who's going to give us his take on the budget yesterday. He's not going to be on the panel, but he has promised me that if you've got any questions that you want to ask about the budget, he'll be there to take them. So don't feel you've missed your opportunity by kindly holding your questions. Then we're going to hear from Marc Roberts, who's also Grant Thornton. Then we're going to hear from David Delaney from IPSX. And then I'm going to open up to my panel of Anna Strongman at the far, my right, your left, Andrew Carter and Claire Slinger from Liverpool City Council. So we're going to get a very broad and varied take on all of the issues. But first, as promised, over to Kersten to talk to us about yesterday's budget.
Thank you, Melanie, and welcome to all of you and all of you online as well. Obviously, yesterday was budget day, so that's the day of the year, or there might be 2 days in the year, when you can all partake in the joy of tax, the kind of stuff I do all day, every day. So budget. What did we see yesterday? I think it's fair to say that there was significant fiscal loosening. I was talking to some of my clients yesterday, and we compared it to fiscal stockpiling, just to give it a little bit of a contemporary touch. And I think that can be broken down into kind of two areas, really. So the immediate bit to deal with the coronavirus and the needs of the country, in particular the NHS, and the kind of more long-term to effectively create future prosperity for the country, in particular, given the Brexit, some of the Brexit uncertainties, the levelling up agenda that Melanie referred to, and the kind of boosting of productivity going forward. So that, if you kind of focus on that, the capital spending for real estate and infrastructure going forward, so a package of about £175 billion for the next 5 years is what was announced yesterday. And I think that's quite unprecedented, certainly the biggest fiscal package, fiscal spending package for quite a few decades. And it was a bit of a mixture there. So the kind of short term was being termed as a kind of shovel-ready projects. So some of the kind of road and more short-term infrastructure projects. One of my favorites, if you go in the slides, is around potholes. So I'm quite a keen cyclist, so I'm quite looking forward to seeing less potholes on our road. And of course, freezes to fuel duty, but also some of the longer-term initiatives, in particular around rail, housing, infrastructure, and of course the NHS. What did strike me as slightly strange, this kind of mixture of investment into the zero-carbon future, yet we have other incentives which go against that, which is investment in the roads and freezing of fuel duty, they do seem to sort of contradict one another a bit. There is some additional funding there for the zero carbon future as well, in terms of particularly about charging points for electric vehicles. And that's certainly something that I know in our real estate team we've been talking about quite a lot in terms of the industry's preparedness for the electric infrastructure that's needed going forward. All of that is actually leading to quite significant increase in public borrowing and deficit. So what were the key announcements? Entrepreneurs relief. I think there was a big expectation entrepreneurs relief might be scrapped altogether. That isn't what happened. The lifetime limit on entrepreneurs relief got reduced from 10 million down to 1 million. It's possibly slightly strange to see that, given that entrepreneurs relief is really supposed to be this incentive for people to start their own business, be successful entrepreneurs. Now, effectively, the tax break that an entrepreneur gets is limited to £100,000. So entrepreneurs relief gives you effective taxation of 10%. So I think the message seems to be, it's okay to be an entrepreneur, just don't be too successful. What else? We had the restrictions in pension tax relief. I think that was probably widely expected. It's quite interesting how it's being brought in, and that the relief gets restricted at a higher level now. So I think in particular that will take some of the kind of medical profession out of it, because I think there was a lot of pushback from some of the kind of doctors, GPs, etc., that actually working extra hours didn't benefit them in their pension. So now pension tax relief is restricted between £200,000 and £300,000 and ultimately it's tapered down to £4,000. Some other changes around the national insurance threshold. One of my pet themes is around the complexity of the tax system for individuals around that national insurance and income tax are set at different levels. We continue to see that effectively the thresholds are different. Really, national insurance is just a tax. And I'm hoping that going forward, there will be some alignment. Now, for businesses, again, corporation tax rate remained at 19%. It was due to go down to 17%. Again, I think that was so widely expected from the manifesto. Some of the more welcome measures were around the structures and buildings allowance. So this is a tax relief for bricks and mortar. So effectively anything that doesn't get a higher rate of capital allowances or tax relief. It was only introduced last year, so that's going up from 2% to 3%. So that will certainly feed in quite well with the anticipated expenditure or public spending on infrastructure and real estate. R&D, there's some more incentives there for R&D, and that again will not only impact sort of what you might call typical research and development type businesses. Certainly those are available for the real estate and construction industry as well. And I'm hoping that some of the conditions will be relaxed to certainly allow modern methods of construction to be included in that. Some of the other things, I think probably the most important one is around the digital services tax has been announced at the rate of 2%. It mentions it's for certain businesses. It's going to be for businesses that with certain digital rights with turnover over 500 million. I think that is a really interesting one, given that the UK will be the first country to introduce that. And it will almost certainly set it on a collision course with the US, because a lot of these businesses are US headquartered. Question mark is whether that comes in the currently anticipated form, or whether actually by the time we come to implement that, the OECD will have their own proposals ready, and therefore the UK will just fold in with the OECD. The other one, probably just to pick up, is around the review of business rates. We were just talking just ahead of the seminar. Something I'm quite passionate about in terms of tax law just not being appropriate anymore to the way we do business and the way people use property in particular. So obviously what we've seen over the last few years is that business rates really have been tinkered with. And clearly it does create some challenges for certain sectors. I believe there's a fundamental review of business rates required rather than tinkering around the edges. I think it remains to be seen whether the government's actually willing to do that, given it's such a big revenue raiser. I mean, business rate raises not much less than corporation tax, so it's a big revenue raiser for the government. In terms of property-specific things, the big thing we've seen is the 2% SDLT surcharge for the purchase of residential properties for non-UK residents. That's coming in April 21, only in England and Northern Ireland. Remains to be seen what happens in Scotland and Wales, although I don't suppose it's actually that big an issue there. Certainly, I think Wales probably not, and Scotland probably less so as well. Clearly, SDLT, or the land transaction tax, is a devolved tax. So it applies to England, Wales, England, Northern Ireland, Scotland, and Wales have got their own regime. They don't have to follow the UK, and they have already got different rates. My key concern there is around complexity, in particular for residential property, the conveyancing, when that happens, what sort of checks does someone have to do? So we'll certainly be inputting into any kind of draft legislation and consultation around reducing complexity and making sure the system actually works for the people who do these transactions. The other thing that really impacts property going forward is this consultation on a new funds regime, an onshore funds regime that's for people that own property in the UK. Now, just quickly on other things, as I mentioned earlier about the kind of incentives for the zero carbon future, I think that's quite clear with kind of the plastic packaging tax that's coming in and additional tax reliefs for zero emission vehicles and just changes to the way that people can claim tax relief for cars generally. Got some short-term measures there as well, which I think were well trialled yesterday, which is around helping businesses with cash flow in the near future, around statutory sick pay in particular. I guess my big question is, and I think that's quite relevant for today, is how all of this is going to be funded. Clearly, there's a big increase in the deficit, but I think the public and the private sector collaboration clearly has a role to play. And I think with that, I'd like to hand over to Marc, who will be talking to us about that.
Kersten, thank you. Good afternoon to those in the room and also online. Yesterday's budget delivered some important down payments on the projects that have been detailed in the papers over the last couple of months, probably over a year, estimated about 100 billion of spend over the next 5 to 10 years. Importantly, most of those still require funding. Obviously, yesterday, making that commitment of 640 billion capital investment in roads, trains, communications, schools, hospitals and power by 24-25 was a very, very important step to commitment to delivery of our projects. What we now need to do is wait for the detail of how the government will raise that debt, and more importantly, how do we access it? As Kersten said, the private and public sector need to work together, as we've seen great success, and we'll hear about it more in a moment, but working together to deliver those projects efficiently and effectively. None of these funding sources really will be new news to you, but I think it's important we just step through them very quickly to say, are we aligned as to what we're using? And I think what Kirsten's alluded to already, that we have to work together to get these projects delivered. We have to look for effective funding sources. And I think those in the room and online will agree, they are probably the 5 most familiar labels or sources of funding or methods of funding. And not to go through them in much detail, but just to quickly touch upon them. Land sale receipt, as it says on the tin, it's an easy way to access money. The concerns always is you don't capture the value, the uplift in value over time of a long-term development or the development of the local area. And so therefore you're losing control and also value. If we looked at private and commercial lending sources, yes, traditional, it involves the income strip income structures. I think the thing we always struggle here when we come to the valuations and we're working with building a hospital or trying to put a green book business case together for a hospital or a prison or something similar, is capturing the value to say, how can we possibly demonstrate what is the end value of that scheme and make sure that it meets all of those criteria, and also we can borrow the right loan to value situation for that particular site. Looking at the third source, PWLB, been extremely topical over the last 12 to 18 months. We've probably read most times in every single journal, property journal, that another council has borrowed some money to go and buy a shopping centre or an office, looking to become more sustainable in their own way in terms of cash flow. And I think, as a fact today, the Treasury, who basically own and run the PWLB now, have changed the lending rates. They're able to set the lending rates effective of today. So whilst we always used to say it's the cheapest source of funding, they're now taking a bit more of a commercial view. It's not that of a high street lending source, but it's getting a little bit more commercial. The interesting thing still remains is that even though Treasury, at the end of the day, hold the pen and the approval, they leave it to the council to actually assess whether the scheme is relevant, and they leave it to the financial director to sign it off, whether or not they can afford to repay that debt. But we've found this extremely useful, and I think will continue to play a part in bringing forward schemes where we need to bring public and private sectors together. If we look at joint ventures, and I would probably say over the last 3 to 4 years, this is probably where we're most busy, and we continue to be busy. We're not only bringing skill sets together, and we hear the government say this time and time again. If we're looking at the feasibility, not only the costing of delivering a new hospital, or if we're looking at a delivery of a new prison, or anything to do with regeneration, which is an important part of our work, they're always looking at various criteria. How can public and private sector work together? How do we invest in a structure where we both can capture value and show return? And that wonderful thing, value for money. How do we get sign-off and satisfied that VFM, value for money, has been met? Now, this is an important vehicle, and I think one will continue to play a role going forward. Probably the one that is best known, well known for all the right and wrong reasons, and it always splits the room as to whether we think PFI as a funding instrument is good or bad. It's perhaps just the application that's tarnished its image. But as it was again confirmed yesterday in the budget, this has been retired. Not my expression, government's expression. It's been retired. But I think the interesting thing is they've set aside £2 million over the next 12 months to look at the reviews of those PFIs. And I think when you start to look at some of the values of those PFIs, and I wrote these down because I really did struggle to actually imagine how many we've actually got. But at this present moment, there's 700 in the UK with a capital cost of 60 billion. And if we look to the future aggregated payments, which accounts for inflation, it comes to 188 billion pounds. Now, a lot of those are obviously coming to expiry, and they need to be dealt with. So again, a funding instrument's going to be required. But let's not think that PFI, PF2, or any other ratio or acronym similar to that will survive beyond yesterday. So it really brings us to the purpose of why we're all here and why we're discussing it. If we look across those exciting projects, and they are very exciting projects, and projects that bring growth for the economy, brings jobs, and at this time that's all extremely important. There's only probably 2 or 3 that we can look to explore how can we develop and fund those projects going forward. There's not one size fits all. I think most of the projects we're involved in, we're having to look at a mix and match of them all. So working with IPSX, we've been exploring how we can bring this other idea forward. And as we've called it, it's option 6. And on that, David, I'm going to hand over to you.
Great, thanks, Marc. So yes, I would like to now, with that fantastic setup, provide you with option 6. I'd like to explain what IPSX is. I'd just like to talk a little bit about the secular trends that we see as meaning that IPSX is the right time for the right environment, and then also touch a little bit on what are the things that we think the IPSX solution will bring that particularly will resonate within the public sector. So, what is IPSX? IPSX is a stock exchange. I say that specifically because every time I talk to people, they go, oh yes, I get this, you're a fund, right? No, we are a stock exchange. We received our recognition from the FCA in January 2019. We're one of the 7 RIEs in the UK, along with London Stock Exchange, London Metals Exchange. We have our technology from NASDAQ. We settle Crest Euroclear. We have market makers like Peel Hunt, Panmure Gordon, RBC. To all intents and purposes, trading equities on IPSX will be exactly the same and have exactly the same look and feel as trading Vodafone shares on the LSE. Hopefully slightly less volatile though. The difference is that we're going to focus solely on institutional grade, single asset, commercial real estate. No one has done that before, and that's why we think this is a particular relevance to the public sector. Now, we have 2 markets at IPSX. We've got IPSX Prime and IPSX Wholesale. We feel by having these 2 markets, we're going to be able to provide everything that the real estate sector requires in relation to different structures and different solutions to provide them with financing. So if I take the first market, IPSX Prime, this is market for all investors from retail, putting £5,000 into SIPP or ISA, up to BlackRock, Blackstone, Norges Bank, the biggest institutions, and everybody in between. This is a market maker market with daily liquidity provided by institutions that I've mentioned before. This is a minimum size of £50 million for assets. It's a minimum market free float of 25% and a maximum loan to value of 40%. So this is a market designed for developed, mature properties. This is a market for widows and orphans in the grand scheme of things. This is meant to be a safe, stable market that all investors will be comfortable with. However, given we know the real estate market doing lots of interesting things that doesn't fit quite into that market, therefore we've developed IPS Wholesale. IPSX Wholesale was granted, as the great phrase is, a non-objection order by the FCA in December of last year. That is for loan to values at 80%. That is for a minimum free float of 1%. That is for institutional and professional investors only. That is for asset sizes of a minimum of 100 million. That is a brokered market, not a market maker market. So that is different from prime. That is also for development properties. That is for more interesting structures. So our friends at Grant Thornton will be hopefully getting very involved in helping us with those sorts of assets. It's potentially to look at offshore vehicles, bringing them onshore. So it's all the other things that we know the real estate industry loves to do and adds a lot of value and yet won't fit into our IPSX prime market. So two markets, IPSX Wholesale, IPSX Prime. Now, what do we think the secular trends are as to why we think now is a good time to have IPSX? So I see three secular trends. The first secular trend is ever since 2008, regulators prefer exchange traded to OTC markets. We know that. The second trend is what I would say describes the savings glut. Excess capital globally in the UK, but globally looking for a home. And the third trend is this, possibly the most scary chart you could ever imagine. This is 10-year gilt yields yesterday, 28 basis points. For those with good eyesight, you'll see the chart goes back to the mid-90s when I was involved in the gilt market, amongst other things, 9%. I remember trading 8 to 21 gilt and mature next year. I don't think in my lifetime I will ever see a gilt with an 8% coupon ever issued, ever again. Now, the interesting thing is, this isn't unusual. The third trend is low interest rates. This is one of my favourite charts, 250-year chart of UK interest rates. What this says is that UK interest rates are generally pretty low. What it says is that actually for the last 200 years, they kind of did nothing. Then it obviously spiked in the 70s with oil crisis and inflation, and then it's basically returned to trend. Now, most people have a frame of reference of interest rates the last 20 to 30 years, so they think we're unusually low. Well, we are a bit low, yeah, 28 basis points on 10-year gilts is kind of low. But the point is, it ain't going back to 8%. It ain't going back to 12%. It's staying low. And so when you've got super low interest rates, or interest rates we're really unused to having at this level for a period of time, that creates an opportunity or a requirement for the investor world who are used to looking at equities, bonds, and alternatives, who suddenly find that actually they can't do any asset liability matching in the bond market when bonds yield basically zero, to look for another source of asset. And so what we think, by taking the £900 billion UK commercial real estate market and making that regulated, transparent and liquid, that's going to create that other asset class for investors who are desperately keen, given this, and God forbid given this, to actually be able to find quality assets at a reasonable inflation-beating yield that hopefully will be a bit more stable than the Vodafone shares that we've seen over the last month or so. So why do we think this is interesting, particularly for this forum in relation to the public sector? I think there are three things. There's a bunch of things we put up here, but I think there are three things that I'd like to pull out that I think particularly resonate with the public sector for what we're doing, and sort of picking up on a couple of things that Marc mentioned earlier. One is flexibility. The benefit of listing an asset on IPSX Prime is you can list a minimum of 25% and a maximum of 100%. So it could be that actually the local authority doesn't want to sell the whole of their building. They actually want to raise a bit of capital and only sell 40%, retain control, because they feel that might be important politically in the area. And so actually using IPSX gives them the opportunity, the flexibility to be able to raise some capital and yet retain control, retain possibly an income stream from managing the building as well, which is what they may want to do. The second thing that it gives them, and Marc touched on this earlier, is best execution. As we know, the government sector rightly is focused on, am I getting value for money? We've had the PFI discussion, all of that sort of stuff. There's arguably no better way of illustrating best execution than an auction market, where you can see what the fair clearing price is through a range of investors. And so this is what IPSX will provide to the public sector, which is very different from a lot of those other funding solutions that Marc went through earlier. The third thing that I think is interesting particularly is this public ownership idea. The idea that local people in the local community can own a piece of the local asset. It's the same principle as Man United fans buying a piece of Old Trafford. If you're in the local area in Bradford and you can own £10,000 worth of Bradford City Hall, for example, not that I've got any idea what Bradford City Hall looks like, but maybe that's a good thing, maybe it's not. That we think from a public sector point of view is really interesting. The idea that you can own a little piece of that should build the community, should build the culture in the community. And so, as I say, there are a number of other things on this slide, but those are the three things that we pick out as I think particularly resonates with the public sector in relation to flexibility, in relation to best execution, and also in relation to the ability to use a funding mechanism like this to build a greater sense of community going forward. That was all I was going to say. Now I'll ask Melanie, fresh from Radio 4 this morning, to come over and host the panel.
Thanks, David. I'm not so sure about fresh after a pre-5 a.m. start, but I'm still on that buzz, that post-buzz, I think. Okay, so let's crack on and hear from our other panellists. Anna Strongman, Managing Partner at Argent. King's Cross is always pretty near the top of the list, whether you're talking about effective partnership and co-working, whether you're talking about great places. So tell us a little bit about your experiences on this agenda.
Yeah, hello everyone. We specialise in partnerships with the public sector. So King's Cross is a great example. The two landowners, actually DHL, private sector, and LCR, public sector, ultimately owned by DFT, with the landowners. And we entered an agreement with them, and ultimately, we achieved planning permission, that land was injected into a partnership. And actually that was a really key move for the success of King's Cross, because Argent, alongside the two landowners, then sat together as unit holders in the partnership to take forward the development. And that meant that our interests were completely aligned from the start. That's not to say the relationship was completely friction-free. It's fair to say that along the way we had kind of bumps and lumps. But I think that alignment of interest, combined with a long-term commitment to the site, meant that we could really develop out the site with a long-term view, and we could really, firstly we could really flex the development approach through the cycles, but also we could invest in things which added value, like the public realm, like an events programme, and over time we could really see the positive impacts of that in terms of value generation. So I think the key lesson from King's Cross was very much the alignment of interests and that long-term aspiration of all unit holders. We also have worked in partnership in Birmingham. It's important to look outside of London, and we're now developing Paradise Circus. We are in a joint venture there with Birmingham City Council, and they're actually using the TIF mechanism to fund a really complicated infrastructure realignment in the heart of Birmingham. And we are, alongside them, we are JV as a master developer effectively, and then we're also plot developer. And I think the alignment of interest there is critical, but also our long history and commitment to Birmingham has really helped to cement that relationship. So I think the Birmingham project, alongside alignment, I think the other element that demonstrates is the importance of trust in a long-term relationship. And trust requires a longevity in approach, but it also requires a kind of open and transparent approach to the relationship. And I think it's fair to say that it requires compromise on both sides, and that's something that we've had to really work through, particularly when we've got our own returns and our own internal drivers. But without compromise on both sides, I think it's quite hard to get these relationships to work. And then the final project that we're working on at the moment is up at Brent Cross South. It's a really, it's a big scheme. It's 7,000 new homes. It's 3 million square foot of offices. It's just to the south of the North Circular, opposite Brent Cross shopping centre. It actually got permission at the same time as King's Cross, which is amazing considering we just started demolition last month, considering all that we built at King's Cross. But it shows that some projects just take a little bit longer than others to get going. And at Brent Cross, we are the master developers again with Barnet, who are freeholders of the land. And then there's a separate plot development arrangement. And again, I think what has come through it is ensuring that our interests are aligned, ensuring that there is trust and transparency in the relationship, ensuring that we're all in it for the long term. And I think also another kind of learning point is actually being alive to the importance of wider benefits and actually buying in both parties into the financial value that placemaking and economic and social benefits and the relationship between those two drivers. So we're working with Barnet, and Barnet really have been a very impressive partner up at Brent Cross, and they have managed to secure 3 million for a new train station. They've worked to decouple the planning from Hammerson in a positive way for all parties. And they're really working very hard with us at the moment to secure a Homes England fund loan on the infrastructure. They're a really excellent partner, and in return they're looking to us to deliver those wider placemaking benefits that we will all see a value from, financial and otherwise. So I think that will be another key lesson in public-private partnerships. So I think each of those projects really has demonstrated different elements of what is key to success in these quite complicated relationships.
Great, thank you very much, Anna. So next to Andrew Carter, Chief Executive of Centre for Cities, and also we now discover a strong advocate for Bradford Town Hall.
I am. If you haven't been there, you should go there. It's one of the best in the country. It's fantastic. It's got no revenue streams at all, so I don't know what you'd be buying, but it is a very nice place to have a wander around and see the leadership in there.
So you're very well placed to give us some insights, not only looking at across the UK at cities and how they're doing, but also maybe slightly more broadly as well.
Yeah, no, very good. So I will start with Bradford, because it's been mentioned, because I think it's the interesting place that the public policy conversation is currently focused on. So I don't know where colleagues in the room where you're focused on, but it's places like Bradford that are front and centre of the public policy conversation. So it's not central London, it's not even central Manchester, it's not even central Liverpool, because we're going to hear in a second that it's doing really well relative to where it was in the past. And it's highly likely to be doing better into the future. But there are conundrums and questions in places like Bradford and others where actually the demand for space, because that's really what we should be thinking about. You're a real estate industry, you're providing space, you require occupier demand in order to fill it, is relatively weak in a place like Bradford. Right? You know, there are problems on the skill side, there are problems on the transport side, there are problems on the innovation side that Bradford is grappling with. These are the kind of things that our public policy is kind of focused on, rightly so. Whether there's a space or real estate provision in those sorts of places, I genuinely am unclear. It certainly doesn't seem to be acting as a fundamental constraint currently, and that's reflected in the sorts of values that we see in those sorts of places. We have to have our front and centre of our mind think about those. The other point I would make, and again, we can use Bradford as an example, but we can roll this out to pretty much every local authority, every city in this country, and this is where the international comparative is really important. There are relatively weak financial and or tax-based incentives for Bradford to be growing its tax base. That's not the same if you go to German cities, which many of you are probably in, or French cities, or Canadian cities, or American cities, etc., etc. We can carry on here in terms of the other places where we are an anomaly. We are most definitely an anomaly. There aren't these kind of strong financial and fiscal incentives at the city scale at least, to do the hard yards. And it does really matter at the margins. I'll give you an example. Because there is no financial incentive to essentially permit more residential development, Oxfordshire is not permitting more residential development, right? It takes all the cost and none of the gains. That's not the case in other countries. So the fiscal context that our cities operate in really does matter. Now, they've got other incentives, employment and growth and general prosperity, but the fiscal issues at the margins, I think, really do matter. And the final point I would make in that sort of space is because of that, their ability to do very complicated or perceived complicated things, like Anna's just talked about, or we've heard from our more financially orientated colleagues, is very, very skewed. It's probably 2 or 3 places in the country that can really get their heads around some of the stuff. I can't get my head around some of the stuff I've just heard. They certainly can't get their heads around some of the stuff that they've just heard. What happens? They don't engage. Now, whether they should engage, whether we would want them to engage, is irrelevant. The capacity is absent because of those kind of fundamental issues in the first instance, which is why devote resources and attention into those kind of spaces rather than anyone else. So always thinking about, whereas if we were in Canada or if we were in Germany, the capacity is more decentralized and there is just a more general level of capacity to engage in these kind of more imaginative and forward-thinking sorts of schemes. So that's a kind of random set of thoughts around how we think about the financial, the real estate offer, its ability to connect or otherwise to what those places are struggling with, and their capacity, because of the way the system is set up, to really do that. My final thought, which I'll share with you, it's a worry I have. I'll share my worries with you. Many worries, too many to mention. But one of them, in a sense, is that over the next X period, we've heard of it, we are going to spend an awful lot of money on buildings and trams and train lines in places that don't need them, right? Because infrastructure is the word of the day and we will want to get this money out. We will probably spend it unwisely in many respects. And my further concern, final concern, is that we have these kind of noises around reformulating the Green Book. I don't know if you've picked this up, right? The Green Book doesn't do what we want it to do, whatever that might mean. So we're going to essentially loosen it to do the things that politicians ultimately want to do. So there's a big role for us to play. And you lot have got a fantastic contribution to make in helping us think very carefully in different localities. What's the real role of real estate beyond just simply saying we can put a building up here or we can put a building up there? That's a random set of thoughts.
Thank you very much, Andrew. And our final panellist is Claire Slinger. Claire, we've heard a lot from the private sector so far. And we've also heard, Andrew's already kindly given you a nice segue in terms of the very exciting things that are going on in Liverpool. So give us a public sector perspective on working in partnership and driving investment and creating great places.
Okay. Hello, everybody. Liverpool's grown quite exponentially over the last few years, but that has actually been about public and private sector collaboration and working. We've recognised that the challenges that our cities face, we can't as one organisation overcome them all. And unless we work with the private sector, particularly in the climate that we're in at the moment with the budget cuts, we won't succeed in the things that we need to do. Liverpool has grown a lot in the last 8 years, and Andrew is absolutely right when he's saying, I'm going to tell you it's doing very, very well, and it will do better in the future. Part of the reason for that is because we've kind of taken a step back and looked at our city holistically, and we've looked at the challenges that we face, and we've looked at what we're getting right and what we're getting wrong as well. What we undertook about 18 months ago was, on the back of an inclusive growth strategy, we've put together a city plan, which is out for consultation at the moment. Now, that city plan is owned by the public sector, but it's a public and private sector document at the end of the day. And we've asked the private sector to contribute to it. And what that plan is actually about creating the right conditions for investment in our city. So we know what the challenges are. We know that we've got health outcomes. We need to improve our employment. We need to increase skills. We need to go out to our neighbourhoods and actually bring those back into the city. We know what the challenges that we need to face are, but we can't tackle them all ourselves. We're out to consultation at the moment. When we adopt the city plan at the end of this year, it will be underpinned by the things that we need to achieve in relation to development and regeneration and growth as well. And we've got a very, very clear strategy in the development team as to what we need to do with our city. We know that we need to attract high-value sectors, we need to expand other sectors, and we need to create the right conditions for investors, both from inside and outside the UK, to look at Liverpool as probably the next big proposition. Because we're not Manchester and we're not Leeds, but nor do we want to be. We've got a really good USP in relation to our cultural sector. We host some of the best events in the country. We've got some headroom in investment terms, which a lot of cities don't have. And we've also got a fantastic relationship with our combined authority, our Metro Mayors and Homes England. So we have access to funding. A good example of that is a Festival Gardens project, which I'm working on at the moment. 1,500 new homes on the waterfront. We wouldn't have been able to do that project without a significant slug of public sector funding, but also working with the private sector who are putting some skin in the game to work with us and get this project off the ground. So we'll be remediating on site this year to the tune of £30 million, and we'll be on site next year delivering construction. Another example of a project that we've undertaken is a £1 billion life sciences development at Paddington Village. We're about to go out to market shortly on Upper Central to seek institutional investors and private partners in collaboration with the universities, where we use our assets to lever in more investment. And we've also got Scientech, which is about to legally complete soon, which is another collaboration between the universities and the council with Bruntwood and Legal & General to lever in, again, institutional investment into our city. So I can't stress enough the importance of public and private sector partnership. We feel if we don't work together, we're not going to achieve our aims and objectives moving forward.
Thank you. Thank you very much indeed, Claire. Okay, you were warned. This is the interactive bit where we hear from you with your questions for the panel. So I'll come to the floor in the room first, and then I'll ask my lovely assistants at the back to help me understand whether there are any questions coming in from the web viewers. If anyone in the room would like to ask a question of our panel? Yes, sir. We just introduce who you are, then for posterity when we record this.
Anthony Abel from TPX Property Exchange. I wanted to ask you a question. I'm quite curious. Hopefully my voice is loud enough for everybody. As a North American, I'm told it frequently is. You focused on the commercial real estate sector. It's a well-established marketplace. I was wondering why you didn't go down the resi side, the residential side. I wonder if you could just perhaps add some pointers to that one.
We've always felt that the commercial real estate side is huge, is well understood. It has clear income streams and hopefully clear covenants behind the buildings if you're leased a shell or something like that. And from that point of view, we feel it's quite easy to understand for investors. And so that's one of the reasons that we focused on it.
Okay,
Thank you.
I'll leave it there. Okay.
Thank you. Another question. Come on, don't be shy. No questions? Any questions coming? No? Okay. In that case, I've got loads of questions, so it's back to me then. I suppose I'm just trying to link together sort of some of the themes that we've heard and perhaps come to Anna and to Claire, both to sort of give us a very specific response to David's pitch around IPSX and its value to you as market participants, and just maybe a response to that and your aspirations maybe for how you'd like to see that develop. Mm-hmm. Claire, you're nodding. Would you like to come to you first?
Yeah, of course. When you're looking at the rates, the sources of funding for the public sector, we've moved on in the last few years in terms of we undertook projects on an investor-owned basis using PWLB, obviously at a far lower rate than it now is. And we invested in assets in and around the city to create Liverpool Pound. We've had to start thinking very differently about that. And we've embraced joint venture and public and private sector working as a result, because we don't have any choice. PWLB at the moment, obviously with the higher rates, means that when we invest in something, it can't be for unsupported borrowing purposes. It has to garner a return. So we're operating quite commercially. We're trying to operate a bit like the private sector. We've been quite cautious and we haven't entered into any income strip arrangements, but that's not because we're afraid to use our covenant strength. We don't have to. We would like to consider anything that is flexible for the public sector, but we've also got to understand from an investment perspective that we do need a return as well. So I think a lot of deals gone by in the past where the public sector have invested in things and there hasn't been the right rate of return, so there hasn't been the money that can then go into those services that are essential for a city's development. We need investors to understand that we are coming at this quite commercially in the future. So we'll be happy to have a conversation and talk about that, because I think it's a really interesting proposition.
Great, thanks. Anna?
Yeah, I think it's a really interesting concept. I suppose we're at the other end of the spectrum, really, because we're doing these complicated developments from the ground up, which take a long time to realise that long-term value. And we raise debt on across our schemes, and we also work with global capital partners to provide equity injections. So we're probably on sort of one end of the spectrum from those kind of standing commercial assets, which invite that kind of investment. But I think it's very interesting to open up real estate to a wider group of investors, and to allow wider participation in that. And I think it'll be very interesting to see if that influences how properties are managed, for example, over time. If there is more interest in ESG, for example, which I know institutional investors are very interested in, but if you get a wider group of participants, what's their attitude towards that, and how's that reflected through your products? So I think for us we're probably sort of starting there, and you're sort of there, but I think it's a really interesting concept for the overall real estate. And I'm sure we've all been through our valuation classes at university, and there's like properties in the liquid asset class, and you're directly challenging that, so it's very interesting.
Thank you. I've got a question in the room.
Shall I just?
Why don't you?
Yeah. So my name's Rob Bold.
Uh,
Okay. I'll do any of this. My name's Rob Bold. The market seems to be fueled on debt at the moment. If you look around the place, what IPSX is doing is potentially opening up equity as opposed to debt. To the panel, the question is, and especially for the public sector, where do you hit your debt ceilings in terms of what you borrow? So I think the public sector, and this is not Liverpool, borrowed £10 billion last year. Yeah. We saw a slide that Marc put up which showed a Spelthorne, a £22 million budget and £1 billion worth of borrowing. This is all looking really suspect when IPSX could offer an alternative from an equity point of view.
Yeah, I find it quite scary, actually, that some of those deals have gone through. I can speak from experience in Liverpool in terms of our approach. We do have a ceiling. We're nowhere near it. We're very strategic about what we choose to invest in, and we will invest in assets that will garner a return. So a good example of that, we bought Everton's training ground, Finch Farm, and then we leased it back to them, and we get a really good rent on that, and the money from that goes into the services. Very simple deal on the face of it. But we've also had approaches to buy large-scale retail shopping centres, branded as this will regenerate that particular part of the city. And we've looked at it, and that's our role, and we should. But we're not prepared to take some of that risk, or we're prepared to take it on a shared basis with private sector having some skin in the game as well. So I think every local authority seems to be operating in a different way. We've got a very cautious finance director, and every deal that we do goes through a very rigorous process in terms of assessment, and we've also got to see some benefits out of it, apart from financial, on the regeneration side and socially.
Thank you. Andrew?
Well, just, not to directly, but just a broader reflection in a sense, I'm sure we all know. I mean, the government is having absolutely kittens over Spelthorne. I mean, they are, keeping them awake at night. Because who's going to have to, who's going to pick up the tab? Well, it's not going to be Spelthorne, is it? The government would have to step in, given that the proceeds are essentially used to provide pay for public services. So there's but my broader kind of reflection, which is this point about the nature of the locality or the local authority and central government. Central government has always, now you might conclude this is a good thing, but has always wanted to keep a very, very, very close control and essentially act as a dampener on localities doing some of these kind of financial innovations and such. And you see the way they moderate the PWLB, and they've done that again yesterday in the budget. They are responding directly to this commercialisation, and PWLB as the mechanism by which Spelthorne has been borrowing to essentially shut that off quite quickly if they possibly can. They'll still allow it for social housing and for other means, with some preferential discounted borrowing rates and all the rest of it. But it's a broader point so the appetite for equity could be quite large at the locality level, but it's HMT that will be sitting there going, not on your life, right? We don't trust you to do that. We don't think you've got the capacity. So as always, we have to be having these sort of conversations at different scales in order to make progress. So even though it feels like a local conversation, you should, the spectre of HMT is never far away when we have that. You know all this, you've been doing this stuff for a very long time, but it's an important point to remember.
Thank you. We're coming towards the end of our time. There's another question here. Yep, fantastic. The microphone is coming to you.
Chester Barnes. I've got a question for David and Anna. Anna, for Argent, you have fantastic projects, but they're very long term, and you mentioned the importance of relationships. How does that square with David's idea that institutions can fund developments in the second tier of the IPSX offer, where you can go in at 50,000? How do you get a relationship with Argent if you're in the IPSX funding style?
On a wholesale market, on the second tier market, not second tier market, the second market. Example of working with Argent would be funding King's Cross, for example. Let's say, for example, King's Cross, great mature development. Let's say that actually some of the participants there said actually would like to extract some capital out of that. They could put King's Cross on our wholesale market. They could then take out maybe a modest percentage of that development, because maybe one of the investors decided they want to take it out. They could then over.
My question is more about the regeneration.
Okay, yeah. Okay, sorry.
Not the end, but the beginning.
Okay, sorry. Yeah, so a good example of a regeneration type of thing would be one of the deals that we're looking at in our pipeline is about a hospital, and they want to build a cancer ward on it, and they have a requirement to part fund from the government and part from the private sector. So in that instance, we're discussing with one of the advisors how we could potentially work with them, where they would put that on IPSX wholesale, and we would provide 100 million of funding. Well, the marketplace investors would provide 100 million of funding to match the government's funding and satisfy the best execution environment. I think it's fair to say that IPSX is not going to be really for holes in the ground. For very, very early stage developments, that's not really going to be, I think, a huge demand for those sorts of projects. Prime is much more for developed projects, and wholesale, I would see it as where there's a development angle to it, but not here's a hole in the ground, let's start digging kind of thing.
Thank you.
Our projects are large and complex, and actually the way we structure our equity is we have a long-standing JV partner, and then we look to bring a third-party equity partner in a bit further down the development when we've de-risked certain elements and we can structure a favourable deal. Even in the complex projects, we get the equity partners in at the right points in time. There are more standalone, more straightforward developments, which could actually part of standing assets when you're looking to redevelop. At King's Cross, believe it or not, we're going to have to start developing some of our early office buildings in 20 years' time, which is a bit scary and probably not a good environmental statement, but that's probably the reality. Within a large standing asset where there are standalone development, maybe that's an opportunity where you could bring look at structuring something.
Thank you very much. I'm afraid we're out of time, ladies and gentlemen. I'm going to give you 30 seconds to have the last word, seeing as you were relatively subdued on the panel just now. So my question would be, what's the size of the prize? How important a role could this play in terms of addressing that option 6 hole in the jigsaw that you pointed to?
It's one of the questions I think was asked a moment ago. I think some of the limitations we have in bringing private and public sectors together is sometimes the rule book. It's either to do with the Red Book valuation, it's either to do with VFM or legal constructs that is an LLP or LLC structure that both parties can invest in. I think what's piqued my interest in IPSX instrument as an option was the way they look at the valuation. So if we are looking at a scheme that's either part complete and phase 2, it has a strong underlying tenant or landlord or income stream that we can identify, the valuation is different. It almost puts to one side the Red Book and starts to look at what is the value of that future asset in that point in time. And as we said with Argent, schemes that take 5 and 10 years to mature, and we're seeing quite a few of those, the ones I listed, but quite a few that we're talking about at the moment, will be 5 or 7 years before we see them. But we know who's going to occupy it, we know how it's going to perform, we know the area it's in. So luckily we can raise more capital at an earlier date to get development security that then secures a better construction contract that gives us better profit and better margins. So from my perspective, it isn't one size fits all, but it's a very exciting instrument, and I think it has a great place. And we're certainly exploring a couple of ideas at the moment.
Great. Thank you very much indeed. Thank you to all of you for attending, both in the room and online. Can I ask you to join me in thanking our fantastic panel? Thank you.
Thank you.